But it's 6 o'clock and we believe in starting on time and respecting your time. My name is John Herhold. I'm a real estate agent in Tennessee, and James Harnsberger has been my tax professional for the last couple years, and he's been an absolute game changer. James is an enrolled agent, licensed by the IRS. And if you don't know what that is, I'm going to let James explain that to you. But I lead a big real estate team, and James is kind of like our financial guy, our tax guy, and for our whole team. And he's got some very unique strategies and concepts that he's going to be sharing with you. And here's what it's going to get you. If you are a real estate investor, you're going to end up being able to do more deals with the same amount of capital after you hear what James has to say tonight. If you're a real estate agent and you're working with clients that are investors, you're going to be able to do more transactions because James is going to be able to show them how to take the same amount of capital and turn that one transaction into two transactions.
Yep.
So anyway, James is out of San Diego. He's been doing taxes for 40 years. He's been working with investors for 30 years. And he got into the tax world because he was selling real estate when rates were like 20%. Think about that. Everybody's complaining about 7% interest rates. James is laughing right now because he was selling real estate when it was almost 20%. And this is how he was able to do it and be so successful. So James, thanks for having us here on Third Thursday tonight. We're excited.
Yeah, my pleasure. Do you want to go ahead and give me back the little wheel here, and I'll bring up the
Yes, sir. Yes, sir.
Let me bring up the little slide presentation here, and let me get this started. And from the beginning, there we go. All right, this should be on everybody's screen. So, John, thank you for that always wonderful introduction, and welcome everybody to our Third Thursday event. If you are in real estate on any level, this is going to be a very important presentation because working with clients over the years, and I work with a lot of very high net worth clients that do a lot of real estate transactions. And my wife and I are also very heavily involved in real estate. And my experience has been that most investors leave half or more of the real profit in a deal on the table because they simply don't understand how to organize the transaction and how to properly look at the real estate from a tax-centric and a financial-centric view. So what we're going to do tonight is walk you through what that looks like. How you do your business will decide how you get taxed, and how you do real estate will absolutely decide how you get taxed. And if you don't have a plan, they have one for you, and it's called theirs. And when you take the word theirs and separate it, it is the IRS. And that plan is meaning that you're going to pay a lot of tax that you probably don't need to. So what we're going to do is we're going to lay out the foundation of, before you ever buy a piece of real estate, understand the kind of real estate that you're buying, because it has unique attributes that are what we call tax character. And not every piece of real estate is the same. Every deal is different, and every transaction can be different. But how you set up doing real estate makes all the difference in the world in how much you actually keep at the end of a transaction. You buy a property, you invest money in the property, you hold it for 5 or 6, maybe 7 years. You sell the property only to give half or more of your profit and your gain away in tax, which is crazy when you don't have to do that, and there's a different way to do that. So I'm going to jump right in and start with entity organization. Deciding how your business structure, your investment structure is going to be set up is critical, because this is going to decide how you're going to be taxed now and in the future. And entity organization planning is a significant part of wealth accumulation and wealth planning, particularly when you're doing real estate transactions and you're holding, maybe you're even flipping properties, and not understanding that each time you do a transaction, the aggregate amount of tax accumulates at a rate greater than what you can keep up with. And that's why a lot of people end up losing a lot of money in real estate, because they're just not aware of how to manage it from an entity standpoint. Two objectives: the entity structure and your investment objectives. When you're investing in a piece of real estate, what are your investment objectives? Is it cash flow and future appreciated value? Or is it immediate capital gain and profit? Whatever your investment objectives are, your tax-centric strategies have to be aligned with that. Otherwise, you're having your money go in one direction toward your objectives, but you're not aligned from a financial or a tax-centric point of view, and you're ended up paying a lot more tax or have overexposure financially because there's no alignment between your objective financially and your tax financially. So these are two very important objectives: how you set up the transaction and what your investment objectives are. Those have to be aligned or congruent with each other. So most investors would benefit from an entity structure that we call a management conduit structure. And I'm going to get into the details and show you some diagrams how this works. Most investors have an investment objective of cash flow and future appreciated value. Remember, future appreciated value is capital gain, is taxable recognition event. Cash flow could also be a taxable recognition event during the holding period. So if we don't have a game plan financially, or we don't have a game plan from a tax perspective, then you're going to absolutely pay the most in taxes throughout the entire holding period of that transaction. And you'll leave a lot of the profit on the table, not even realizing that you probably could have made twice as much money. So let's say that we're going to do an entity structure with a management conduit. You're going to own 100% of the stock, or maybe you're married and it's a husband and wife and you each own 50-50 of the stock. We're going to make it very simple, very easy to understand. You have a corporation that is set up. It is a specific purpose enterprise corporation, what we call an SPE, because its specific economic purpose is to be a management conduit. A management conduit. And it's going to manage everything that you do in the world of real estate through this corporate structure. And you're going to own 100% of the stock, or you and your spouse are going to own 100% of the stock. Part of the objectives for the management conduit at the corporate level is we're going to take advantage of corporate America. We're going to set up a corporate compensation plan, officer compensation, some corporate benefits, working condition fringe benefits, medical and expense reimbursement plans, car allowance, and fringe benefits. All of the goodies that increase your standard of living, most of which are not even taxable if they're set up correctly, so that your compensation and benefit plan at the corporate level is set up to be there when you have a lot of money coming through in profit and you want to shift that into your entity structure correctly. Some of the things that we look to in setting this part up is review the financial organization of the business, look at how the business is set up and structured. We look at that analysis. We look at corporations, limited liability companies, partnerships, self-employed, solo investor. We do compensation analysis, benefits analysis, tax modeling for the last 3 years, the current year, and the projected next 3 years. We look through the lens of everything that would touch or be directly or indirectly related to this real estate investment opportunity, so that you have a well-defined platform that's going to allow you to make and keep more of your money and profit once you put your capital to work in real estate. Let's talk about the design. This is the most important part of this, the actual design. We go through and look at, for limited liability companies, what the operating agreement needs to look at, because we're going to be using two kinds of LLCs. We're going to look at the corporation bylaws. We're going to look at the compensation plan. If there's not one, we're going to propose one. We're going to look at the benefits plan, the retirement plan, your investment plan. We're going to look at how you do and keep books and records. We're going to look at any payroll and compensation review, bonuses and other benefits, and any other particular things, like if you're involved in crypto or other things that we want to have into some review and consideration, so that when we make the step to design the plan, we actually have taken everything into account as it should be, in making sure that it's a holistic plan. It has taken everything into account. We start with a corporation that is a specific purpose enterprise corporation. It has a specific purpose in life. It is going to be a management conduit to one or possibly two different LLCs. These LLCs will be member managed LLCs. You and the corporation will own the shares of the LLC. Let's say if you're married, you and your spouse would each own 45% of the shares of the LLC, and the corporation would own 10% of the shares. But because of the uniqueness of an LLC and the disproportionality rules, the LLC can give 90% of the profits and losses to the partner corporation and move those profits and losses up to the corporation and out to the shareholder owners of the corporation. So in effect, we have a partnership at the LLC level, one that's doing flips or short-term holding 2 or less years, one that is holds or long-term holding 2 or more years. And that's because the tax attributes on flipping property are completely different than the tax attributes of holding property for long-term. And they're completely different if you're developing property. So we're looking to design the LLC specifically for the purpose for which it is designed, as well as the corporation, so that they're congruent in the financial objectives, and at the same time, they are tax centric. The corporate compensation and benefits and working condition fringe benefits and defined benefits, all of that is up at the corporate level. These LLCs will never, as long as they exist, have any taxable income. They just absolutely will never have any taxable income. Now, we take the next step, and the LLCs pay to the corporation, in this example, 90% of all profits and losses. The LLCs are taxed as partnerships. You're the partner and the corporation is the partner. So we get to take advantage of some of the partnership attributes and rules, like return of capital instead of guaranteed payments, which are not taxable when you return the capital from the LLC back to you as the partner. And instead of misclassifying that as a guaranteed payment and paying self-employment tax on it, we're actually going to do a return of capital. This matters when you have a big transaction and you're looking at a lot of capital gain, and most people by default elect to do a 1031 tax deferred exchange because they've got all this gain exposure and they don't have a plan. And so their plan is to defer. And the problem with that is that at some point that you run out of runway in being able to do that. So an example is that the corporation is a managing member of these two LLCs. On the one side, property 1, 2, and 3 are short-term flip properties, 2 years or less. And the reason is because there's no depreciation allowed or allowable on those kinds of properties. Everything has to accumulate to the basis and be a basis adjustment. And you don't want depreciation triggering a recapture event on a property that you're going to flip or hold for less than 2 years. So the tax character of that property is radically different than on the other side of LLC2, where those properties were holding for 2 or more years, generally 5 to 7 years. Because if this is set up correctly and they're rental properties, the tax savings and the cash on cash
Sounds
will
like you're
equal
not feeling well.
will equal somewhere between 50 to 60% or more of what you invested in the property. So how you invest in real estate matters. The property type and its character, along with your investment objectives, all have to be clearly defined. So we begin with that property type and character and identify the following types and character for a number of critical reasons, because the tax rules are not equal in how they're applied to different kinds of property. If you have a residential rental that's a single family house, that's going to be completely different in the tax treatment than if it was multifamily, like a duplex or a 5-unit, or even a 12 or a 13 unit. If you have a rental where you have maybe a hybrid, an accessory dwelling unit, like a granny flat added to it, that has a very different tax character than a duplex. And what we have to do is understand the nature and type and character of the property before we can start deciding what is going to give you the best in the way of benefits to that property. And like I said, most investors leave most of the profit on the table because nobody's educated them about how to set the transaction up to begin with before they jump into escrow. And all of a sudden, they're paying a tremendous amount more than they have to in taxes when they get ready to sell that property, and they don't know how they're going to hold it for the period that they're going to have it. So again, real estate investing should consider using formal management, or what we call conduit structures, specific purpose enterprise corporations and limited liability companies, creating partnerships where the corporation becomes the managing member and it's a member managed LLC. And we take advantage of the disproportionality rules that allow us to take a 10% shareholder of the LLC in the corporation and give the corporation 90% of the profits and losses and shift that income and those tax harvesting opportunities up to the corporation. That's where we're going to do all of the serious planning. We're also going to employ the use of cost segregation studies, but beyond that, we're going to take that study and we're going to do an asset allocation of all of the asset groups and create a hybrid between straight line and maker's depreciation. We don't want the tax trap of recapture of depreciation to come back and haunt us 5 or 6 or 7 years down the road when we have to add it back and tax it as part of the ordinary income or gain. So we're going to use a hybrid approach to the cost segregation study, and we're going to map out and plan how that hybrid depreciation is going to look. Then the corporation will enter into a management agreement with the LLC so that management fees can be paid to the corporation and eliminate and reduce taxes significantly through a management agreement between the corporation and the LLC. And give you an analysis and just a peek at a pro forma. Here you have a property that was $1 million. The land was 200,000 of that million. The improvements on the land were $45,550. Improvements like the driveway, the sidewalks, the grass, the trees, the shrubs, the fence, the sprinklers. All of those improvements on the land are depreciable assets under the 15-year rule. So that leaves us a raw land of about 153,000. And then we've got about 800,000 for the building. So we're going to take the building and put it into these 4 asset groups And we've got, let's just assume this is a duplex and it's 2,500 square feet. And let's just assume that the average rent right now is about $1.50 a square foot. We've got a loan balance of $750. What does this property look like in a 7-year holding period? Well, the depreciation breakout tells us in years 1 through 5, we're going to get a total of $67,000 in depreciation deduction, which will save us $26,871 in federal tax. If we have a conservative gross scheduled income forecast based on the $1.50 and a 5% annual increase, then in year 1 and 2, we know what our income is, we know what our operation expenses should be, and we know what our depreciation is. So we have a taxable profit of negative 32,527 with a management fee of 13,000. So we have a negative taxable profit of negative 45,000. And you have all that cash. Then the appreciated value, assuming only a 5% annual appreciated value and debt reduction, our equity plus our cash means that we have in year 1 and 2 a return of between 284 and 352. Again, with our gross scheduled income, our operating expenses, and our gross profit. We take our gross profit and add our tax savings to that, and our cash return is $61,000 in the first year and $64,000 in the second year. At the end of 7 years, we've taken $427,000 in depreciation. Most of it has been straight line method on the 5 and 7 year asset groups. That has saved us $171,000 in federal tax. We've had $401,000 of income, but we had a taxable profit negative 240, so we didn't pay any tax on any of this income. And the cash in the bank with the gross profit and tax savings is going to be $474,436 for a property that you paid $1 million for 7 years earlier. And that's about half of the cost of the property. And I'm being conservative on the cash accumulation. If you do a proper rent survey and actually understand how rents really should work on an investment property, that's the second area where most investors lose the most amount of money. Well, I've got great tenants and I don't want to raise the rent. Then you should not invest in real estate because that's not going to make you any money. And part of that gross scheduled income is making sure that that asset is performing at the most and highest and best use possible. So when we roll this all together and you have a properly structured business organizational structure to do as much real estate as you want to do, you can actually double every 3 to 5 years your holdings in real estate with the savings that you're going to have and the cash on cash return that you're going to have. And so most investors, if you're a real estate professional working with investors, they really need to go through and do this pro forma analysis in advance before they jump in and start doing all of the real estate transactions. And they don't need a different LLC every time they buy a piece of property. They just need a properly structured LLC with a properly structured corporation so that they can do the things that I'm suggesting that they should do. And I do this for clients that are making millions of dollars on a transaction, and it works out the same way. It's just the money that they're saving has just got a few more zeros next to it. The real estate industry is going to explode in 2024 for obvious reasons. The Fed has already hinted at 3 rate cuts. The market is already pricing in 6 rate cuts for next year. It's an election year. And we're going to see continued contraction in housing availability, especially in multifamily and rental property. And anybody that gets into the real estate industry or into investments in real estate, you'd almost have to work against yourself to lose money. It is really going to take off in 2024. And in some areas of the country, it's already started, like here in San Diego, we're already seeing appreciation in multifamily north of 10%, and probably will by the mid-year of next year, we'll be at 15 to 18%. That means that we're outpacing the country by almost 10%. So there are areas of the country, particularly in Texas and a few other areas, where it hasn't quite started yet, but it's about ready to. And when it breaks through, it's going to be everybody looking for property and no inventory. So I look forward to talking to everybody that might be interested, and I'll take some time right now and answer some questions. Just in case you'd like to make an appointment, you can scan that or go to the ITWS Financial Services.com and make an appointment and get on my calendar. I'd be happy to have a consultation, free consultation, and answer any questions. And from that, John, I'm going to stop the share, and I think I'll just open up and take any questions.
Yeah, it's great job, James. If anybody has any questions, feel free to unmute yourself and ask questions, or you can drop them in the chat.
Hey, James, Greg McCullough here. Do you have an opinion on being designated as a real estate professional to gain any more benefit from the structure that you just explained out? Because I know that historically I've benefited significantly from having that designation.
Yeah, there's a 4-point test, and there's 2 alternatives to the test. The simplest test is the 100-hour, and you can also count the time of your spouse if you're married as part of that qualifying period. That affects your personal return, assuming that most of this activity is going to happen at your personal return level. Okay, I'm suggesting not to do that.
Okay.
The designation of a real estate professional is important. It's a tax distinction with a difference. You don't have to have a real estate license. You just have to meet some very minimum requirements. You would want to do that in any event. But all of your activity in investing in real estate is going to be at an entity level, passing through to the corporation from the LLC, and then passing from the corporation to you on your personal return. That way we get the opportunity to have a lot of bandwidth in how much that we can do planning at the entity level. And I'll give you a perfect example. 3 years ago, we bought a property next to our 5 units. It was on the corner. It had a house, it had an outbuilding, it had an attached garage and a detached garage. It was converted to a little ADU rental.
Yeah.
We looked at rehabbing the property and maybe flipping it. We decided, no, we're not going to do that. We went to the city and we said, give us a permit. We want to scrape the lot and we want to build 2 duplexes. The city of San Diego said, no, no, no. We'll let you scrape the lot, but you can't build 2 duplexes. You can build 12 units. So we scraped the lot. We put $575 is what we paid for the property. We put another $50 in scraping the lot and getting the clearances done. So we got $625 in the property. We listed it in the market in October. 8 days later, we got an all-cash offer for $1,250,000. The LLC got paid $1,250,000. It paid the corporation $675,000 in a management fee. And in the $675,000 management fee, my wife took a salary for $250,000 and made a defined benefit contribution for another $250,000. We had a $100,000 tax loss on the LLC, and we had a $30,000 tax loss on the corporation. And I have about $600,000 sitting in cash in equities because it's self-directed in a retirement account that will grow to $1 million in about.
That's beautiful. That's a whole nother level. I love it.
And paid not one dime in tax.
That's amazing. Amazing. Understood clearly. Thank you.
Yeah, there is so much unlocked opportunity that if I could help a real estate professional, you should be making $100,000 a month, literally a month, with this knowledge, talking to investors, getting them into deals. at
Mhm.
least 100,000 a month,
Absolutely.
because they don't have any direction. And the sad part about my industry, the tax industry, it's only 2 steps away from used car salesmen. Most of the people that do tax returns in most of the states, there are no requirements. Somebody can hang out a sign and just start filling out forms. And I know this because I've been doing it for 40 years, and I get hired to clean up a lot of those messes that other people are making on your tax return and everybody else's tax return. Okay.
Mhm.
I'm an enrolled agent. I had to take 3 admissions exams, like a bar exam, to be admitted to practice before the IRS. I'm
Mm.
also a CVA, a credentialed certified valuation analyst in taxation. I'm also a credentialed paralegal in taxation. So I think I got this tax gig down, right? What
Absolutely.
we have to do is help you help the client and let the data do all of the talking. You don't need to talk. Let the data tell the story.
Mhm.
Because the client doesn't understand that if they had just a little bit of planning, in 5 to 7 years at the most, 50 to 60% of what they invested in that property, they're going to have sitting in the bank and no tax liability.
Mhm. That's amazing. Really. I love it.
All right, who's next? I'm on a roll now. Got me fired up.
Thanks for cracking the egg, Greg.
That was
Anybody-
awesome.
Anybody else have some questions, comments? I know Laura had a couple clients on here tonight.
Cool.
Yep, I do. Thank you so much, James. I do have 3 of my investor clients on. Thanks, guys, for showing up today.
Awesome.
This is so awesome. I really wanted them to delve into what I've been on several calls with you and several masterminds, and it's still really hard to understand. But every time I hear it, I'm texting them. I'm like, bam, like holy cow! It just blows my mind every time. You know,
The
I
whole thing about success, financial success in real estate is like anything. Is you got to be able to measure whatever that success is, right? So we can measure that in the dollars that you keep versus the dollars that you invest. I think the most important thing that you could do to benefit your client as a trusted advisor is help them understand the pro forma and the analysis before they make an offer or before they list the property, so that they're getting in position to maximize the basic principles of real estate investing, and that is the highest and best use. That is the foundational level of investing in real estate. It's highest and best use. Oftentimes, the investor doesn't know what the investor doesn't know, and the real estate professional can't talk about taxes, right? So we've got this dilemma of how do we get the information to the investor in a way that makes sense to them. That pro forma that I just took a couple of screenshots and showed you, that is a very extensive worksheet that was designed for all kinds of different types of transactions. You give me a property and let me plug it in, and I will tell you where the opportunity really is. Not only will I do that, I'll show you how to structure the transaction and maximize the tax benefits that'll put thousands, tens of thousands of dollars back into your pocket the minute you close escrow. That's a game changer.
It's a game changer.
Awesome. Thanks, Laura. Anybody else have any comments, questions, anything they want to ask James?
Hey, James, can you hear me?
Yeah, go ahead.
Hey, it's Jason.
Hi, Jason.
This is kind of off of script. I'm just curious to get your opinion on it. I see they're handing out like licenses for Airbnb, and they're putting a cap on it. How do you think that'll play out as far as, demand on the real estate market and all that stuff?
So you're going to have continued growing demand in that sector, and you're going to have continued shrinkage of supply. Airbnb is one of a host of different channels that allow for that. But what we're starting to see, particularly here in California, Arizona, and a few other states, is we're starting to see more regulatory oversight or requirements enabling to the cities or the counties to go in and regulate that. There are some legal challenges to that that are going to work through. Here's the thing. When you're analyzing a property that is a rental income producing property, the most critical thing is to understand the kind of property and its potential. And that's why we do a comprehensive rent survey, not a rent comparison. Rent comparisons are worthless. A rent survey takes it to a whole different level by the square foot, and we look at every aspect of what that property's costing per square foot and what its income potential is per square foot. Now, I'm not a big fan of rental properties that are single family residences, because if you have 1 month that it's vacant, you have 100% vacancy rate for that month. Whereas opposed to 5 units, if I have one vacancy for a month, I have 20% vacancy for that 1 month. Over the year, it's not that big of a deal. Okay. So the number of units times the number of rental days as a percentage, how many days were rented versus how many days was it available to be rented. Then the per square foot analysis of cost factors per square foot X debt, and then what the rent is. And what I've found, and what my wife and I have found, and other investors have found, that renting that property as opposed to an Airbnb is going to pencil out almost always better. And the reason is the longevity over time of the sustainable income. When we rent out any units that we have, we give the tenant one price. They don't have to pay for water, sewer, trash, gas, lights, any of that nonsense. And we send a maid, and we have a laundry service that we throw in. They get one price. And our rentals bring in 30% above market cap in that zip code, above everybody else. And we don't have near the turnover that everybody else has in our rental property, because they get one price for everything. And here's the deal. If you manage your utilities, we won't have as big of a rent increase next year. And guess what happened? In the first year, our utility costs went down almost 22% in the first year. So when I compare that to what we could rent out on an Airbnb in a single family versus that capital going to work in a 4, 5, or 6 unit, hands down, the multifamily will outperform every day the tax benefits and the financial benefits than an Airbnb.
Thanks, James. One more question for you. You mentioned that the Feds were going to decrease interest rates 3 to 6 times next year, and I think the market's projecting it to start in March.
Right.
I know with equities, the first rate cut is usually a strong correction in the market. Is it the same for real estate or not really?
It's not going to be the same for real estate, because we have a couple of other factors that we've not seen. Number one, we've got boomers right now that are flush with about $110 trillion in net worth, a good part of that in real estate, and they're downsizing, and that trend is growing probably at about 15% a year. So boomers are armed with a lot of cash, and they're buying up those smaller properties and paying cash for them, plus buying multiple units, and the inventory is still shrinking. So with that, I think what we're going to see is we're going to see price escalation still above 10% in most areas, particularly big metropolitan areas like San Diego. It's going to be above 15%. And I think we're going to see continued shortfall and shortage of available units in multifamily. I just think it's going to get worse, not better.
No, I totally agree with you. You know how the Federal Reserve's main goal this last bear market was to crash the housing market, and they clearly have failed at that.
Right.
What do you think, like, does this become a political statement or moving forward, with the younger generations unable to buy in? And I know this is completely off topic. I'm just curious of your opinion, but what do you think happens from here with that narrative?
I think you're going to see a lot of disruption politically and economically, particularly in these big blue states and these big blue cities. The reason is because they haven't produced enough reserves, adequate reserves, and their bond. Just watch what the bonds do. A lot of these cities are going to be downrated to B grade or C grade bonds, like Chicago. All of those bonds are going to get re-indexed in January, February, and March, and you're going to see millennials and this younger generational group. The only way that they have a chance of getting real estate is to go to their boomer parents or boomer grandparents and borrow the money or get a gift of the money. What I do think is going to happen is we're going to see relaxing of the standards, like with Fannie Mae right now. You don't have to come in with 25 or 30% down. Now you can come in with multifamily, 2 to 5 units. You can come in with 5% down. You're going to see that change with FHA, with all of these other lending practices going into an election year. And it's going to make it easier for people to get in. But if there's no inventory for them to buy, I don't know what's going to happen.
Yeah, thank you. It's very interesting.
Yeah. And look what the yields did on the bonds the other day.
Oh, they're crazy.
Yeah, the Fed
yeah.
hinted that they were going to do 3. The market priced in 6, and all of a sudden we took more than a 1% haircut in the market, and the bond yields just tanked.
Yeah, it's pretty crazy. The stock market's anticipating this. If you look at the TLT for the 20-year, I mean that chart's beautiful right now as far as a technical analysis. But yeah, you're absolutely right. The bonds are telling you everything.
Money will go where it's going to be treated well.
Right,
So
exactly.
capital is
Yeah.
going to go out of California and out of states like California and go to states where it's going to be treated better. Tennessee, Kentucky, Texas, all of those states are going to be mecca opportunities in real estate.
Yeah, I think you're right. Thank you. Appreciate it.
Yeah.
Hey, James, I have a question.
Go ahead.
You mentioned something about the 1031. Of course, we know the capital gains when you're doing an exchange, and about deferring it. So my question was, obviously, a lot of us made mistakes in however we purchase property and how we've been handling it in our tax returns. But when we go to buy our next property and we want to do a 1031 exchange, can we clean that up as we go into our next property?
Yeah, so you got to be a little bit mindful and understand the mechanics that envelop 1031. First of all, you may not change the character of its ownership.
Mhm.
So if you own it as a solo investor or with your spouse, and you want to 1031 it into another deal, you can't change its ownership character to an LLC and be able to do that. Okay. Second, you're taking the existing depreciable basis with you to the next property. So there's no harvesting opportunity on that next property. Whereas an alternative to a 1031 would be a reorganization plan. Move the property into an LLC and let a corporate structure manage it, then put it on the market, then have the same situation that my wife and I did when we got rid of that vacant lot that we scraped, and have that money go up. And if you don't have a place to go, then take it out in compensation and then start loaning it back to your business to buy your next deal.
Okay, so you can clean it up. You just have to go back and clean it up before you sell it.
Well, you'd want to do it before you put it on the market to sell, yes.
Got it. Okay, thanks.
And we call that reorganization planning. The sweet spot in multifamily is 2 to 8 units. Economically, that's where you're going to get basically the highest return for the lowest amount of capital and the lowest amount of risk that you're going to have is in that range of 2 to 8 units. Now, that's not to say that a 10 or a 12 unit or a 14 or a 15 unit doesn't make economic sense, but your dollar per door and your dollar per square foot and the return that it gives you in terms of planning hits that law of diminishing return. At some point, the more you do, the less you get for doing it. And you run out of bandwidth in tax incentives to be able to make sense on a 20 unit unless you overcapitalize your investment, in which case then your yield or your rate of return internally is going to be much less because you're taking on more risk. So the analysis is really to find on any given property what its characteristics and what we call the sweet spot really is. What is that ultimate rent? What is that ultimate tax benefit? What is that ultimate planning strategy? The minute you close escrow when you acquire a property, you should have a pretty good idea of when and how you're going to dispose of that property. What is your optimum holding period? Some people it's 3 to 5 years, other people it's 5 to 7 years, and we've got some clients that they want to hold it for 20 years and have the income because there's very little or no debt. And that goes back to what I started with. Identifying and defining what your investment objectives are, because that's going to define somewhat to some degree the structuring of the entity and how we're complementing the entity structure to meet those financial objectives. And I can tell you that the financial objectives for flipping real estate are completely different than for holding real estate for long-term appreciated value. And the tax strategies are modeled completely different. All right. Any other questions? This has been fun.
Absolutely. Any other comments, questions?
One comment for confirmation and then a question. So cost segregation seems to be a very specific integral part of almost every single one of the case studies that I've seen from you. So that's pretty much across the board, that highest and best use cost per square foot is factoring in exactly what you're able to squeeze out of that.
Right.
Cost seg is a critical part.
That's called stacking.
Yeah. Yeah. And then my other question, completely separate from that, I was just to confirm, is what is your view, or do you have your finger on the pulse of what the trend is for the hedge funds for single family rental movement, as far as, are they going to be just voraciously gobbling up? Are they unloading certain areas? What's going on there from what you've seen?
There's more money coming into that, and there's more money sitting on the sideline that'll be coming in after January 10th to Bitcoin, because the ETFs are all going to get approved probably on January 10th. And the reason is, if you go and peel back and actually read their financial reports, the ones that are publicly traded, what has happened and has been happening, and I predicted this about 5 years ago, that the mobile nursing industry as an industry sector is going to wildly explode in the next 5 to 8 years. And the reason is, you have 11,500 baby boomers turning age 65 every day, and that will continue for the next 15 and a half years. Okay? And people like me who are baby boomers are not going to a nursing home. You can shoot me, put a bullet in my head, and kill me, because I am not going to a nursing home. I will die in my house. Okay?
Likewise.
So with that understood, and with the understanding that this market shift is accelerating beyond what they had forecast, we're looking at 20% a year right now. Mobile nursing is one of our tenant preferences, because they get a juicy per diem for their housing allowance.
Yep.
And I love renting to two nurses who are hardly ever home.
Exactly. The place is pristine. They hardly even use the
Yes, of
the
course,
kitchen, you
I'm
know?
getting a premium for rent because I'm giving them maid and laundry service too.
Mm, amazing. Awesome. Thank you so much for that. I appreciate it.
What, I mean, look, we pay about $1,000 a month for the maid and a little bit for the laundry, but we're getting 30% above market norm for rent. We took a property that was doing $70,000 a year to $130,000 a year, and not a dime of it is taxed.
You know, the name of the game seems to be who's the best bird dog at identifying inventory right now, you know? That's
Yeah,
what
exactly.
it always has been, but it's that much more critical now.
But if you had this tool and you could model that, you're going to know what other people don't know. And when they're looking at a deal and they think it's a shitty crap, excuse my language, but it's a crappy deal, right? You're going to find that diamond in the rough,
Yep.
and you're going to be buying it because the numbers told you to buy it.
Yep. Beautiful. Yeah, the whole idea of buying right, it's a whole new perspective applying these strategies and principles. That's awesome. Thank you so
Yep.
much.
Absolutely. John,
Anybody-
how
James, it's been a great call once again. Everybody else that joined us, I know some folks hopped on last minute. We appreciate you guys jumping on, and hopefully, I know you found some value.
and we'll get the link, John. We'll get the link to you so you can distribute it to everybody, and we'll put it up on the website so you can get the link and go back and watch it if you want to watch it again.
Yep, and anybody that's interested in getting a consultation with James, you know, James, you want to throw the page up again one more time just so people want to get on there? We can.
You know what? Yeah, let's do this. If you go to ITWS Financial Services.com, just hit that little button right there and get on my calendar, and it's a free consultation. Actually, it's a free analysis. If you want me to do a little bit of modeling, I'll put a couple of hours of my time and kind of model a transaction and just kind of show you how it works. What I would suggest that you're doing, particularly those of you that are real estate professionals, what a recruiting tool that you have here to go get other agents that might have that door open for other investors. And the investors right now are trying to figure out how to go into real estate and make any money make sense, right? Because everybody's concerned about interest rates. Look, I was doing transactions when interest rates were 19.6, okay, back in the 80s. And I was doing 2 to 4 units, and I was listing property. I was making insane amounts of money, and I never dealt with buyers. I only dealt with the sellers. And that was because during the 1980s, we had the investment tax credits that they could use. So if you owned a property free and clear, I could get you a listing. You could sell that property, carry back the financing, take advantage of the investment tax credit when you did that, not pay any taxes on your installment of sale, and take your capital gain and reinvest it in the next property and have Uncle Sam pay for 40% of that. It was crazy. And we're seeing the same thing today, right now, unfolding right now.
Great time to be in real estate.
It's an awesome time to be in real estate.
And here's the great thing too. There's so many people with their heads down right now, and all they're talking about is how crappy the market is. Rates are too high. You know, they just got all this stinking thinking going on, but they're not looking in the right place. And if you're an agent, this can completely separate you from all the other agents.
This is a major game changer. You let the data do the talking. When we can perform the pro forma and we can model and we have the basics that we need for the data, it's all data driven. You don't have to sell anything. It sells itself because you'd be crazy not to do it when you see the numbers work out. Okay. That's part of my expertise, not only as a tax expert, but as a valuation expert. I look for the hidden value in every business or every real estate deal. And that's my job to the client, is to find that hidden value. If you've got the investor, let's get the property, let's do a model on it, let's see what it looks like. And that's going to tell us the opportunities and the kind of structuring of the transaction that actually takes a crappy deal and makes it a good deal.
Beautiful.
Yeah, it's awesome. It's awesome. This is why I get up at 4:30 in the morning. I get excited
We can tell.
to get started.
Well, thanks again, James, for pouring in everybody tonight. And, everybody, thanks for jumping on, especially those that jumped on last minute. Obviously, it's a amazing time of year. So Merry Christmas, Happy New Year. If you got anything you want to get set up for 2024, get on James's calendar. So, and the best time everyone's saying, well, I'm just going to do it this year. No, you should do it or next year. You should do it this year.
Yeah.
To get set up for
Only have a
2024.
few
You
days.
want to go into 2024 set up the right way.
Right.
So anyway, thanks, James. Appreciate your
All right.
time.
My pleasure. Everybody have a great night. Thank you so much.